Hey everyone, welcome back to the deep dive. Today we're going to be taking a look at something that's really key to building wealth over the long term.
Okay.
And that's this idea that just starting to invest now is generally way more effective than, trying to predict the perfect moment to jump into the market.
All right. Right.
I think we've all had that feeling of wanting to wait for like a dip or
Yeah.
try to figure out, is the market going to go up or down? Should I wait? Should I not?
Totally.
And so today we're really going to dig into why that invest now approach tends to be the winning strategy. And we're going to do that by drawing on some pretty compelling research that's out there.
Okay.
We know you all are busy and you want to get to the heart of this quickly and thoroughly. So that's exactly what we're going to do.
Awesome.
Really give you a solid understanding of why taking action now can be so beneficial for your financial future. We'll also touch on how our emotions can sometimes get in the way when it comes to investing.
Oh, yeah, for sure.
And the surprisingly huge impact that just being consistent can have. But before we get started, just a quick reminder that everything we're discussing today is for informational purposes only. This isn't financial advice.
Of course. Yeah.
So let's dive right in.
I'm excited.
So this whole concept of trying to time the market, it sounds so smart, right?
You feel like a genius, right?
Like you're this super savvy investor, you're
Yeah.
going to buy low, sell high.
I got it all figured out.
But what does the evidence actually say about our ability to actually do this consistently?
Well, the interesting thing is that evidence really consistently shows how hard it is.
Yeah.
I mean, incredibly hard. Bordering on impossible, really, to predict the highs and lows of the market consistently.
Right.
Think about all the different factors that are influencing the market at any given time. Trying to consistently get that right is incredibly risky.
Yeah.
So historically, yeah, the probability of being able to do that is super low.
So that brings us to this principle that you hear all the time in investing, which is time in the market beats timing the market. It's like the golden rule almost.
It's almost like a mantra, right?
Yeah, exactly.
So why is simply being invested for a longer period so much more powerful than trying to get in and out at the so-called perfect times?
Well, if we zoom out and look at the big picture, it comes down to a couple of things.
Okay.
One is that despite all the ups and downs we see in the market, historically, the market has generally trended upwards over the long term. So, for example, if you look at the S&P 500, which tracks a lot of the big companies in the U.S.,
Right.
the average annual return has been about 10% historically.
Wow.
That's a pretty significant driver of growth if you let it do its thing over time. And of course, it's important to remember this is an average. There can be a lot of fluctuation year to year.
Right.
But that's why staying invested for a long time is so important to kind of ride that overall upward trend.
Okay, so 10% a year on average. That's pretty impressive. But I can imagine someone out there listening thinking, yeah, but what if I somehow managed to avoid a huge market drop
Yeah.
and then buy in like right before it surges up?
Right. Wouldn't that be even better?
Well, that's the bet you're making when you're trying to time the market right. And it raises a really important question. What's the potential cost of being wrong?
Oh, yeah.
Or even just missing out on those periods of highest growth?
Right.
There was a really interesting study that I saw that found that if you missed just the 10 best days in the market over a 20-year period,
Oh, wow.
your returns could be cut by more than half.
Seriously?
Just 10 days out of thousands
Yeah.
can have a huge impact. And the reason that missing those days is so impactful is that a lot of the long-term gains are often concentrated in those short bursts of really strong performance.
So it's like you're trying to win a game by only showing up for like the highest scoring plays.
That's a great analogy.
Mm.
And if you look at the data, if you look back at some of those big market downturns like the 2008 financial crisis, it's really understandable that people felt scared and pulled their money out.
Right. Of course.
But people who stayed invested or even reinvested during that time, they saw the S&P 500 more than triple in value in the following decade.
Really?
And the same thing happened with the COVID crash in 2020. We saw a really fast recovery. And those who tried to time the very bottom and stayed out of the market, they missed out on a lot of that initial rebound.
So these downturns, which can feel really scary in the moment, can actually be opportunities if you have the right mindset.
Exactly, and that's a big part of it. It's shifting your perspective and looking at those downturns as a chance to buy quality investments at a discount. I mean, when prices are lower, you can buy more shares with the same amount of money. And as the market recovers, those investments have the potential to really grow.
Right.
So we saw that with the recovery after 2008. Even more recently, there was a 10% dip in the market. And that presented a buying opportunity for people who were thinking long term.
So instead of panicking when the market drops, we should be trying to look at it more like a sale.
Yeah, exactly. Think of it like a sale at your favorite store. It's a chance to get more of what you want at a lower price.
Now let's shift gears a bit and talk about something that's often called like the cornerstone of long-term investing.
And that's compounding.
Compounding, yeah, it's a big one.
We hear this word a lot. Can
hmm
you break it down and explain why it's such a powerful force, especially when you start investing early?
Sure. So the key thing about compounding is it's like this snowball effect.
Oh,
Your earnings start to generate their own earnings. So those returns that you make on your initial investment, they start to generate their own returns and so on and so on.
right.
And over time, that leads to this exponential growth.
Wow.
So the earlier you start investing, the more time your money has to take advantage of that compounding.
Right.
It's kind of like planting a tree. You know,
I like that.
the sooner you plant it, the more time it has to grow and produce fruit.
So even small amounts invested early can grow really significantly.
Exactly. And that ties into the power of consistent contributions.
Okay. How so?
By adding to your investments regularly, you're not just growing that initial amount you invested, but you're also giving that compounding a bigger base to work with. So for example, imagine investing $500 a month.
With a hypothetical 7% annual return. Over 30 years, that could grow to over $1 million.
That's incredible.
That's the power of combining consistency with long-term compounding.
Wow. So even those what might feel like small monthly contributions can turn into big wealth over time
Yeah, it's pretty amazing to see it work.
if you're patient and consistent.
Exactly.
And consistent investing also leads to this concept of dollar cost averaging, right?
Right. So when you invest a set amount of money on a regular schedule like every month, that's dollar cost averaging.
Okay.
And what happens is you end up buying more shares when prices are low and fewer shares when prices are high. So it helps to smooth out your average purchase price and reduce the impact of those market ups and downs.
So it takes some of the emotion out of it.
It does, exactly. It's more about sticking to your plan than trying to perfectly time the market.
And that brings us to another really important point, which is market volatility.
Yep.
You know, it's a fact of life when it comes to investing,
It always does.
right? There are going to be upswings and downswings. But historically, the market has always recovered over the long term.
That's the key to remember. But the danger is when we let our emotions dictate our decisions.
Ah, yes.
Emotional investing.
I think we've all been there.
Oh, yeah.
Wanting to sell everything when the market dips or,
It's tempting, right?
you know, jumping all in on the latest hot stock tip.
Yeah, you feel like you got to get in on the action.
But the data really suggests this is not the way to go.
Yeah, emotional investing often leads to the opposite of what we're trying to do.
In what way?
Well, fear can make us sell low during those downturns. And that locks in those losses and prevents us from taking advantage of the recovery.
Right.
And on the flip side, greed can lead us to buy high, chasing those quick gains, only to see them disappear when the market corrects itself.
It's like our instincts are working against us.
It really can feel that way.
Yeah.
So having that disciplined long-term strategy is all about overriding those urges, sticking to your plan, not letting those short-term ups and downs throw you off course. If you can do that, you're much more likely to benefit from that long-term growth potential and the power of compounding.
Okay, so to sum it all up, the real message here is don't wait for that mythical perfect moment to start investing.
Yeah, it's a myth.
Because it probably doesn't exist. The best thing you can do is just start investing now, even if it's just a small amount, and be consistent over time.
That's the key.
That consistency combined with the power of compounding and a disciplined approach to riding out those inevitable market swings. That's what really leads to success in the long run.
I couldn't have said it better myself.
Well, this has been a super informative deep dive. The fact that time in the market is so much more important than timing the market, that's a really valuable takeaway.
It is.
And realizing that market downturns can be opportunities and that compounding is such a powerful force really highlights why it's so important to start now and stay invested for the long haul.
And one last thing to think about. If you make even a small, consistent investment today,
Okay.
imagine what that could grow into in the future if you give it enough time.
Right.
And on the flip side, think about what you might be missing out on by delaying
That's a good point.
that potential growth, the power of compounding. It's definitely something to consider.
Absolutely. A lot to think about. Thanks for joining us for this deep dive into the world of investing.
My pleasure.
And if you found this discussion helpful and you want to explore more of these crucial aspects of investing, be sure to subscribe for more deep dives in the future.
We'll see you next time.